Hello, Microeconomics students. We're now in week 2. We enjoyed reading all your responses from the week 1 forum discussion. We have another interesting one I posted out there this week related to the Olympics in Brazil and a little bit of a concern for the Brazil economy. So I'd like you to read through the article and also watch the video by the individual from Moody's and his assessment about Brazil and their situation, and then based on the questions I put in the forum discussion, make sure to make your initial post by Wednesday and then follow up with your peers throughout the week. So it ties in really well to our discussion this week, in chapter 3, looking at supply and demand, kind of the meat and potatoes of economics, if you will. And also chapter 4 delves into more of these issues about maybe the signals that market sends and how people adjust, whether it's with labor or where a government might intervene in the market with a price floor or price ceiling. I kind of liked how the authors of the textbook said, don't kill the messenger, because markets are trying to tell us something. But as with the example in the Olympics, perhaps the government has to go in and buy up the extra tickets. Is that really in the best interest of the market? So that's the debatable thing about economics. But looking at some of the key concepts this week, start off with chapter 3. You're going to look at a prominent model in economics we call the supply and demand model. If I want you to think of it this way, if there were many individuals that we can measure, how much they would be willing to demand at various prices, what would be the quantity that they would want. We could sum those all together and come up with a market demand curve. We could also do that same thing with supply. Think of supply as the producers that will bring the good to the market. I could sum up all those individual businesses and what would be the overall market. Say if the market was for apples, consumers that demand apples at various prices, and those apple producers that are willing to supply the market at various prices. And when these two curves intersect, that's what we call like a point of equilibrium in the market. I like to use the word that the market's clear. So in just dealing specifically with demand, it is an inverse relationship. That is, the price goes up, the quantity demanded goes down. And as we move along a demand curve, I want you to think of it simply as a change in price. So if the price of apples went up for you, you would move along your demand curve and you would consume less apples. If the price dropped, you'd move along the demand curve and you consume more apples. With supply, it's a positive or direct relationship. So if you're willing to pay more for the apples, I will supply more to the market. But if you're willing to pay less, I will supply less. So that's just specific to price. And we call that a change in quantity demanded or a change in quantity supplied when it deals specifically with price. Now, when there are factors other than price, if we think about them from a demand perspective, examples might be consumer income. If that goes up, that could shift the demand curve out, and that is a factor of the price. Or if incomes go down, that could shift the demand curve in. So as you're doing your forum discussion this week and you think about the tickets and how they're having problems selling the tickets, think about some of the things that are causing the demand curve to shift in for that ticket. Also, other things can be expectations, taxes can be an impact too on demand. And when we look at the supply side, any shifts of supply are also factors in price. So that could be technology, that could also be subsidies and taxes. It could also be expectations about the future, whether a farmer thinks that oats are going to be the next hot thing out there, so he might plant more oats. But again, these are all factors that are listed in your book that get to the idea or concept that it's other than price. It's something that's shifting the market. And then once a curve shifts, a lot of times these are displayed as just single curve shifts, even though in markets sometimes market forces have both the curve shifting, but a lot of time for illustrative purposes they just have one particular curve shifting and they show the impact. So like with the Olympics in Brazil, the idea is if the demand curve is shifting in, that less people are going to see the games and the price in theory should drop. Now, one of the problems might be if the government does not lower the prices, and that's when the government may have to step in and buy the extra tickets, or you just see not a lot of people in the seats because the price is too high. So, when you get to chapter 4, you're going to look more, maybe some more specific examples with supply and demand. It ties in well with our forum discussion from last week when they start to talk about the supply of labor and the demand for labor. Your demand for labor is somewhat derived. It's your ability to add revenue product, if you will, or to add value. And supply of labor is going to change because of the dynamics of education, human capital, as people move in and out of markets. So obviously, the fewer people in that market, if there's less of a supply, the higher the wage. Sometimes this can be done by just having to be certified to do a certain profession. Actually, being a dentist or doctor, you have to be certified to do that. And that actually benefits those, probably set by the AMA and the Dental Association, that you have to have these skill sets before we can let you have a doctor. So in a way, it kind of restricts the supply, and it helps boost their wages in the market, if you will. So what they do with the kind of the first part of chapter 4 is they look at wage being the price, if you will, and the quantity of labor in a market. One other market they also look at too is the financial markets. And with the financial markets, you can have a supply and demand for loanable funds. If there is a big supply in loanable funds, which has kind of happened mostly through the Federal Reserve right now, and in fact this past week they decided that they're not going to raise interest rates, and it may be a while before they raise it again. So they're going to still push out that short-term money supply and even long-term money supply, so that's kept the interest rates relatively low. But if the economy starts picking up steam, they feel fairly confident about the future, they will start restricting that money supply, and the price you pay for money is an interest rate, so that will start to go up too. And just the last part, they talk about in that terms, what we call like a market system as an efficient mechanism for information. So people are constantly gathering information or hearing information about markets. I was reading an article this week about Mitsubishi and how they had lied about their emission standards and maybe mileage. So right now, Mitsubishi is suffering the causes of that. They are probably going to produce less cars, and they're also probably going to have some demand impacts. And as that demand impact decreases, they're probably going to have to lower their prices to convince people to buy their cars. So they're going to be less profitable. And information in markets have already discounted their stock price and said, hey, we got to lower their stock price because the expectations of their earnings are going to go down too. So markets can be very efficient at times. And what the authors of the textbook wrap up for this week in chapter 4 is that sometimes governments may intervene in markets through price floors or price ceilings, something that you'll also read about in chapter 3, where a price floor basically says, hey, you can't go below this price. And minimum wages is a good example of that the government imposes that you have to pay at least $7.15 or 25 cents. A price ceiling would be something like a rent control, that you can't charge above a price. But oftentimes when governments intervene in markets, although they have good intentions, it doesn't allow markets to clear. It doesn't allow it to get that equilibrium price, if you will. So you may set the minimum wage at $15 at certain cities, but perhaps at $15, firms aren't going to hire a lot of people, but a lot more people want to work at $15. So although you think that you're improving the situation, you've actually created more unemployment. So that's something that cities have to be careful with, and even the federal government, not so much federal, but probably more states and cities have to be careful with about how high they set a minimum price floor. So, but again, the textbooks kind of allude to the idea that killing the messenger is like sometimes the price floors or price ceilings might be a way to say the markets understand what needs to be happening, but by the government stepping in and creating a price floor or price ceiling may actually just be making things worse off. Okay, well, that is it for this week. I look forward to talking to you online, so continue to plug away on your homework and the forum discussions, and I will talk to you online. Take care.